Hello, I'm Boots Dunlap, and this is Boots on the Ground podcast, the number one podcast on real estate private credit, or at least as we think so. I am joined today with Charles Dougherty, who is an economist at Wells Fargo, who exclusively covers real estate. Where are you finding great indicators as to how the jobs market is doing in the U.S.? And there's a lot of noise. How do you kind of sift through that? And then, the strength of consumers and U.S. businesses.
Yeah, it's very challenging. It's not impossible to get a read. It's just an incomplete read, I would say, right? So we have a wide array of different publicly or private source data, I should say, that's also publicly available, right? So it could be the ADP payroll numbers, it could be job postings from Indeed, it could be existing home sales, for example, from the National Association of Realtors. So there's still data, that's flowing. It's just not giving us the total view of what's happening in the economy right now. And so we kind of consider that, the BLS's, monthly employment report to be kind of the gold standard. And I think that's still true. It's become a little bit noisier, over the past few years for a variety of reasons, I think. But it's still sort of a very good benchmark for us to kind of estimate where activity is currently at and where it might be going, over the next few months or even years.
And so they are actively reporting now. I think you said the BLS just released the September numbers. Was that correct, or
they're going
to catch up?
So the BLS, as we're sort of sitting here recording this, they'll put out the September employment report this week, and then they're probably going to have another report that's either delayed or maybe comes later or earlier in December. So there's still a lot of confusion, not a lot of clarity there. But they're sort of trying to switch the lights back on and see what they can kind of produce in a timely manner. And it's important because we have a pretty critical decision from the Federal Reserve that's kind of coming up. It's sort of fast approaching. So again, it's not just the private sector economists and forecasters who are relying on this data. It's policymakers and especially at the Federal Reserve that look very closely at the top line data and all the underlying details, which really helps sort of inform decision making.
And so that data is outdated when it is released. And you're looking at a lot of other data right now, Charles. Mm-hmm. With what you're seeing, possibly before we get into some of the economic research that you've provided, which we can get into, but what is your feeling on how these job reports are going to look and where the economy is today, just in terms of overall jobs for here we are in November? Late November, I should add.
Right. I think if you look at the trend, you always have to distinguish between individual data points that by themselves don't really tell you a whole lot about the overall trend. So I prefer to have at a minimum a 3-month moving average, right? And what you saw over the summer, looking at the labor market, was a clear moderation in terms of employment growth. So the number of new jobs being added every month slowed down quite a bit, and that kind of tells you that the labor market was sort of gradually cooling. Now, September, October, November, again, you have privately provided data that are kind of telling you that it's more of the same, right? Meaning, did the labor market degrade further? Hard to say yes or no either way, but if you look at, the ADP or Indeed or any number of other of the indicators we look at, it's basically pointing to, still probably cooling, not a whole lot of evidence that there's a material degradation that's happened since then. Not a whole lot of signs of improvement either. So if you're thinking, okay, it's gradually cooling, maybe that trend has continued. So I think that's probably the best guess. We'll see when these labor markets eventually come out. But I think the overall point is, on trend, what we're seeing is a much more moderate, cooler, softer labor market. And that's really important, especially when it comes to the Federal Reserve and monetary policy.
So the question is, what's causing the softening? And also,
Right.
There's a lot in the headlines with Amazon layoffs and Verizon layoffs, and those obviously attract, the news, and they get a lot of airtime. So I think a lot of us are asking, with AI, tariffs, maybe just the economy's running really hot now for a very long time. It's one of the longest bull market stretches. Why is the economy specifically? It's probably multiple things, but in your estimation, why are we seeing this softening now?
I would attribute it to, 3 major things. One, and I think this is certainly worth mentioning, is that we still have restrictive monetary policy. So the Fed, started to reduce rates September of last year, but rates are probably still restricting activity. Higher interest rates are certainly limiting hiring among businesses, and I think that's an important place to kind of start. The second is we've had a significant change in a wide variety of different economic policies this year, right? So whether that be trade, immigration, new fiscal policy, deregulation, and you can kind of tease out the impacts of each one of them. But on the whole, there's been a significant change, and that's introduced a lot of uncertainty. So when you have high levels of uncertainty, I think that's sort of been a headwind for hiring this year as well. And then sort of the third thing, we saw very strong rates of economic growth over the past few years. We saw businesses hiring, at a very fast rate. And I think what's happening here, and maybe this goes back to tight monetary policy, but you're seeing businesses, I think, start to right size a little bit. And so I think you can kind of consider those three major factors as sort of the main drivers of what's been slowing down the labor market. And then you kind of think about maybe AI and its potential impacts to hiring. I think it's hard to really see exactly where that's sort of having the biggest impact. I think it's probably still too early to kind of chalk up AI as one of the main reasons why the labor market is slowing. But I think more and more you're gaining evidence that it is sort of having an impact, right? And we'll probably talk a lot more about that. But I think those sort of big three factors are the main sort of drivers behind this sort of sluggish labor market that we find ourselves in.
So that's a good segue to two things. If you wouldn't mind talking about U.S. real GDP growth, where you see it going, or at least Wells Fargo, their forecasts, and then the consumer, in spite of a pandemic, interest rate increases, a lot of instability, at least the upper end of the U.S. has been doing very well and spending a lot of money. What's the resiliency of the consumer? So if you wouldn't mind talking about both of those, and I think we also may have some slides we can put up as well, but love to hear your thoughts.
Yeah. So I think, to sum it up in one line, I think GDP growth has been very resilient this year, and I would expect that to continue, right? So it has been sort of a choppy year in terms. If you look at the quarterly growth rates, right? You start the year off, you have this change in trade policy, you had a big surge in imports, a lot of businesses sort of front-running this new sort of tariff regime that we find ourselves in, and that kind of mechanically reduces GDP, and then you saw the reverse happen in Q2. And so you saw some volatility in the numbers, right? But one I think important point you pointed out was that you at the top line in the aggregate, right? You have a consumer that is still out there spending, right? And the consumer is almost 2/3 of GDP. So in the aggregate, what you have is consumers that are still driving growth. And I've actually, you look at the numbers, right? We don't have the numbers printed yet for Q3. But right now it's tracking, north of 3%, which is actually a pretty solid result. And maybe it's a little bit of the, trade and import story happening that's kind of giving it a little bit of boost, but it's mostly that resilient consumer that's really driving things. So the consumer is still kind of holding up, I think, for a number of reasons, right? Again, in the aggregate, what you have is incomes that are still kind of flowing in the household sector, right? The labor market, it's softer, but it's still kind of holding up, right? And so incomes are still growing, in a positive way, probably more moderate, but you're still, seeing income growth, which is kind of supportive of overall spending at the current moment. So it's a consumer story. It's an AI story too, right? So you have business investment that's really been strong, in the tech sector, right? Whether that be businesses, investing in new software and hardware, or it's just, this really big increase in data center construction that we've seen. But you kind of sum it all together, and what you see is that the AI impact to business investment has been a really significant support factor on overall GDP.
Well, and I think, if you look at the S&P 500 and you take out all the AI correlated stocks, I don't know that, that might signal that we maybe are, in a recession. I mean, not that it's GDP focused, but there's been a lot of growth to U.S. equities, and I think U.S. GDP growth is a result of the potential that people see in AI and the productivity gains that we think maybe we're already experiencing them. I don't know if you have any thoughts on that. But I don't know if you have any comments around any of that.
Yeah, I think there's this narrative of the K-shaped economy, right?
Yeah.
And it shows up in a number of different ways, right? So if you look at the consumer sector, yes, overall consumer spending is still growing, but there's certainly strains happening, at the median income and below. And the median income and above are doing a little bit better. And so you see that in equities as well. But
you see it in real estate.
You see it in real estate, right?
In real estate markets as well.
I mean, you look at the office market, right? It's bifurcated. Yeah. You look at the hotel. It's the same story.
Yeah.
Where, and so you're seeing this sort of narrative and theme across a number of different aspects. So I do think that that's absolutely occurring. But it still, I think, matters when you look at the overall aggregate numbers. You're still kind of seeing growth, right? And there's always, you kind of go back in history, there's always that sort of differential, among different sectors, among different asset classes, and such. So it's not entirely unusual. Maybe it's become more pronounced because we are, I think, sort of at the forefront of something new, and I think sort of transformative in terms of the economy, right, with regards to AI. But it's certainly been a significant growth driver, so far. The question is, how long will that go on? But I do think you have to sort of caveat everything with, yes, we're still growing, the economy is still expanding, the cycle's intact, but there's strains kind of happening beneath the surface that we sort of need to monitor.
Yeah, I have to admit, as a real estate person, and on the real estate credit side, you look at the private equity side and mostly venture capital and tech, they have so much money, so much capital that they can make big moves that really affect the economy. And I remember when tech was booming, and I was just at a conference, the Mortgage Banker Association does a private credit conference, and we're talking about, when tech was booming, they were driving up just salaries across the board. It was really hard to hire anyone because they were absorbing and sucking all the talent in tech. And then all of a sudden they shift and they're not sucking. So now there's excess capacity for a lot of really qualified people. And they did the same thing with real estate, where they were sucking up all the real estate. And then they pivoted and they didn't need as much office anymore. They're working remotely and they kind of throw that office back on the market. Data centers is interesting. They're right now sucking up a lot of capital and a lot's being done in the data center space. I don't know if they're going to, eventually, if 10 years from now, if we're going to have, way too much data center capacity. And you see it with energy as well, where, they really weren't too focused on energy. In fact, to some extent, I think, largely very conservative on that. And now, tech companies are building nuclear power plants. So
Right, yeah,
it's like,
yeah.
I feel like they're such a driver in the economy. They absorb so much capital. We react largely to what they're doing. The economy's reacting to, AI and now data centers. I don't even know if it is really real estate or if it's, an energy or an infrastructure play, but that is a lot of the capital in real estate is going towards data centers right now. So yeah, I think it's fascinating. I'd love your thoughts on what's going on in data centers briefly. We don't do a whole lot of that, but it's clearly, a lot of capital's moving to space. I might personally feel as though it's, maybe somewhat of a bubble. There's some point where I feel like these hyperscalers are building their own data centers and they're eventually going to migrate into them. But tell me about, from the real estate perspective, data centers. What's your view? What's your thoughts? And then feel free to opine on any of my riffs on sort of how AI and then just, AI scalers, tech companies are impacting real estate.
Yeah, I think, it's always helpful to kind of turn to the data when there's such a sort of air of uncertainty around any particular topic, right? And so the data we have, one shows a really significant rise in new data center construction, right? So you hear the headlines, but it's those projects are moving forward. The amount of spending on data centers has more than tripled, over the past 3 years, right? So we're building a lot, and just based on the new starts that you see, that number is going to continue to go up. We're still trying to get our arms around the demand side, right? Because as you kind of rightly pointed out, if you kind of read what the hyperscalers are saying, if you look at what they're doing, everything we're building in terms of new data centers is being leased up or purchased or occupied, right? And so if you look at vacancy rates for in this sort of nascent and like burgeoning data center sector, depending on which source you're looking at, they're either flat or declining, right? And we'll go through this. Most others, commercial real estate property types have seen vacancy rates come up over the past few years. So I think that's telling you something about the current state of data centers. And it's really, I think you have to mention about sort of the supply constraints, whether it's energy, water, land, that could start to push back on that. But the demand kind of seems to be, borderline insatiable at the current moment. And I'm not the expert to kind of go through and say this is, one thing or the other. But it does seem to be a very significant growth area, and the experts who do know about AI and who, we have the latest version of whatever, chatbot, but they're seeing what the versions are what are going to be coming down the road, right? And so they're seemingly as optimistic as sort of the growth rate on the current rates of data center construction is. So I think that's kind of telling you something. It's hard to predict what's going to happen, but it seems like one of those areas that's going to continue to grow.
There's just been so much capital in the space. I don't know if it was the debt amount or the full value, but there was a data center, and it was a $30 billion, again, either capitalization for the whole construction or just the debt piece on it, $38 billion. Do you know what of all other real estate, you know what the most expensive commercial real estate property in the U.S. is?
What's that?
It's here in the city, One Vanderbilt.
Oh, okay.
And it's valued at, I believe, maybe $3 billion. I have
that's
to check that.
interesting, yeah.
So you have, one average data center that is more valuable, which is incredible. And it obviously impacts the capital markets. I mean, there seems to be plenty of liquidity for that right now, which is great. Not so much for office, but although that's a great office. But I thought that was just an interesting data point. Okay, so we'll get off data centers a little bit because I admittedly am not an expert in them. But one thing that I think was interesting is looking at the tariffs. And you've obviously done a lot of research on this. Wells Fargo has as a whole. There's concern that we're going to experience more inflation. But how much more inflation is there? And I think what is CPI most recently is around 3%. Is that
yeah, thereabouts. I mean, yeah.
And so as you think about the tariffs and the impact towards inflation, what percentage of CPI is truly comes from goods that are imported? What sort of and no one knows where these tariffs will land, but the assumption is that maybe we've hit sort of the peak Trump negotiation of starting with really high tariffs and maybe pulling them down. What are your thoughts on the effects of tariffs on the economy, and then we can get into maybe how that impacts real estate. Mm-hmm. But we'll start with inflation in general.
Yeah, I mean, you kind of take a step back, and what you have seen is kind of most measures of inflation kind of drifting very slowly higher, right? So yeah, the CPI, the PCE deflator, which is sort of its cousin, right? Both have kind of moved up, and you can think of them as around up 3% on a year-to-year basis. And so tariffs, I think, have certainly played a role, right? So if you kind of look beneath the surface, what you see is goods prices being the main driver behind the increase this year. And if you kind of dig down even more, it's household furnishing items, software processing equipment, music instruments, stuff that's heavily imported. Mm-hmm. So the tariffs, I think, are having a modest upward force on overall inflation. But I think the more interesting question, which you kind of pose, is how much longer is that going to be in the data? I think that effect will be there. Because what you see is it takes a long time for tariffs to kind of make their way through supply chains. A lot of businesses, as we talked about before, kind of got ahead of new tariffs, and they built up large inventories and then sold them down. And so as they sort of restock at prevailing tariff rates, mm-hmm. then maybe the first half of next year, you're still going to see that upward force on inflation. Now, are we going to go up significantly more from here? I don't think that should be your base case. Meaning, I think, maybe we hover around 3% over the next few months. As you move through 2026, the effects of tariffs on inflation start to kind of fade away, mostly because, if you think, okay, yes, it's going to take some time for tariffs to make their way through the supply chains, and we understand that. But from a theoretical standpoint, a tariff should only represent a sort of one-time impact. Because you put a tariff on something, the price goes up by the tariff amount, and then so long as there's that sort of an upward adjustment to tariffs, then the price growth should be flat, and that's sort of what inflation is. So theoretically, the impact of tariffs should start to fade away over time. So it's there, right?
And so what's over time? You're saying to work all the way through the supply chain, and then some of the excess inventory that was maybe before the tariffs went in place brought over. You think it's like 6 more months of experiencing some of the effects of the tariffs?
I think that's about right? So first half, I think you still see the upward force. Not meaning inflation's going up mm-hmm. above 3% necessarily, but it's still kind of exerting itself on the numbers. Then back half of 2026, I think you start to see maybe the numbers kind of tick down back towards say 2%, which is where the Federal Reserve would like them to be.
Yeah.
But yeah, I think that the overall message there is that yes, tariffs are creating an inflation source, right? And it's probably not going to be permanent, and it's going to start to slowly fade away. It's just going to take a few more months to kind of get through that period.
One thing that I think is interesting, I love your comments on, is in my very little research, it seems as though tariffs, maybe more on a longer-term basis, are deflationary,
right?
Because they impact, potentially even softening in the economy, which creates deflationary pressures. So I'm curious if you have, any thoughts to that. In terms of, you were saying we might just work through the one-time inflation, but could this actually create deflation over the course of time?
I would not say deflation, maybe a better way to say that would be disinflation.
Disinflation,
right?
sure. Okay, well, downward pressure on inflation.
Exactly. But I think that's certainly possible. And it's interesting you brought that up because there's a new study put out by the San Francisco regional Federal Reserve Bank, which essentially came to the conclusion, which you just said, where inflations have a range of different effects, but the negative demand consequences sort of outweigh the upward price push from tariffs.
Yep.
And so the modeling that we did at the start of the year kind of tells that same story, where you have this initial upward push, and then unfortunately you get slower economic growth, higher unemployment, slightly higher unemployment.
Yep.
And that serves to kind of bring in a sort of disinflationary force, which kind of pushes down on the rate of inflation over time. So I do think that those effects are certainly at play. It's a very complicated subject.
Super complicated.
Yes, and there's a wide range of things that could happen, right? Versus, there could be exchange rate effects. There could be, substitution effects with consumers and how they shift their preferences on, higher prices. But overall, I think that's sort of what our modeling suggests, and what this sort of really interesting new paper from the San Francisco Fed kind of also sort of purports.
Yeah, yeah. I think inflation. You're saying roughly 3%. I did a quick study beforehand over the past 75 years, and I kind of cherry picked my time zone. I didn't want to include the Great Depression in there. But over the past 75 years, do you know roughly what the U.S. inflation rate has been?
No, I'd be guessing so. Yeah.
Okay, 3.8%. So 3%. There's a lot of concern about it, but what you're saying is probably not going to get a whole lot higher than 3% potentially. So as we are looking at inflation, and this is sort of my pitch to the Fed to lower interest rates, my hope is that we're not going to see a whole lot more of it. But even still right now, in spite of such large tariffs, and I think this false connection that's being made between tariffs and long-term inflation, I don't think that, we're in a place where we're going to be experiencing any runaway inflation anytime soon. So that's my thought. But I don't know if you have any thoughts on that.
I generally agree there. So you have the tariff issue, right, which is certainly, I think, at the end of the day, no matter how you slice and dice it, it's probably inflationary. But inflation is sort of this complicated process, and you're not seeing a whole lot of other forces out there.
Mm-hmm.
Labor market softening, you're seeing wages come down. Doesn't seem to be a huge, maybe neutral impact to inflation right now. Commodity prices, maybe tariffs are boosting steel prices, aluminum prices a little bit, but overall oil's come down this year, so not really making significant moves either way. So that's kind of neutral to inflation in my view. Inflation expectations have kind of remained anchored, meaning consumers and businesses aren't really anticipating a whole lot of future inflation. So that, to me, the overall story here is that yes, there's some mild inflation happening, which you have to certainly be vigilant on, and I think the Federal Reserve is going to be very cautious because of it, but which kind of I think helps alleviate some of the concern is that if you kind of look around more broadly, there's not the same inflation pressures that we saw, as an example in 2021 and 2022, which would be really sort of concerning in my view, that inflation was going to sort of run away. Yeah.
So tying that back to interest rates, which commercial real estate, for better or for worse, is highly correlated to interest rates. And no one can predict interest rates, but making a case to the Fed, would you be, and it's really interesting too, sorry to kind of ramble here, but the Fed governors, I think the dispersion between opinions on rate cuts has never been wider. There seems to be more sort of dissenting opinions in the Fed, which isn't great for certainty and trying to figure out what direction we're headed. Where do you kind of see in this next meeting and then over the course of the next year, do you think more likely interest rates lower, higher, same?
Yeah, so our base case is for a cut in December. There is more disagreement.
And that's 25 basis points, right?
25 basis points. If you look at market probabilities right now, it's about a 50% chance, so it's a coin flip essentially. And the reason it is, and if you go back a few weeks, it was a higher chance of a 25% cut, a 25 basis point cut, excuse me. So it comes down to you are seeing more FOMC voters sort of vocalize their views, and what you're sort of starting to see is there's more disagreement, right? So there's a few people on the board, right? A few of the governors who are in favor of cutting even more than what the consensus is sort of expecting. There's several regional bank presidents who have votes at the FOMC, but they've come out over the past week or so and sort of voiced concern that maybe the inflation problem is worth kind of continuing to focus on, meaning maybe they don't do anything in December. So it's still, the Fed's still on the fence, I think, for December. But again, I think what's really important is to remember what we kind of started off talking about, which the labor market has cooled significantly, right? And so you're sort of on the cusp, it kind of feels like. And so you look at the totality of all the labor market data we have, and it kind of points to greater downside risk potentially compared to the maybe upside risks that you see on inflation. So if that's the case, then I think the Federal Reserve will eventually come down on the side of reducing by 25 basis points, because you want to kind of protect the labor market and sort of prevent sort of an unwelcome deterioration in conditions from here. The challenge for the Fed right now is, again, they are just as reliant on the government data as we are. So they don't have the latest and greatest on the labor market. They do have the September inflation report, but all of the data for the next few weeks, there's going to be a high degree of, if we do get it, a high degree of uncertainty around it. And so I think that's sort of clouding the issue as well. So it's going to be a close call. I think the bar has been raised for a December cut, but I do think it's still a reasonable base case that 25 basis points lower, in the final meeting of the year is going to happen.
And do you think there's a targeted, maybe an adjustment in the inflation target that the Fed is seeking? It seems like 2% has been really hard for the U.S. to ever maintain. And I am curious if maybe 2.5 or even 3%, could be seen as maybe an acceptable. And I was telling someone else, in the real estate world, we always have inflation bumps in the leases. And as long as I've been doing this in close to 20 years, it's always been like a 3% bump is what you're saying. And you're not trying to make money off the tenant. Just kind of assumed that going back 3.8% was historical average today, but 3% is reasonable inflation, right? So I am curious, you think there's going to be any changes in trying to keep rates high until we hit that 2%? Or I know there's cutting going on right now, but on really the Fed target?
I don't think they'll change the target, at least anytime soon. Maybe they look at it afterwards, after they get inflation back down to 2% or near it, then they'll kind of reconsider it, right? The 2% target's somewhat arbitrary and relatively recent, right? It kind of was developed in the 1990s for a variety of reasons, but they have kind of always adjusted that around the margins, right? There was sort of an average inflation target that they put into place because, as you mentioned, right, they've never really successfully averaged exactly 2% over a sustained period. So you go before the pandemic, it was actually we were right between 1.5 and like 1.8, and actively trying to get inflation up to 2%. And then of course COVID happens, and we had the big inflation run up. The opposite has been true. But I mean, if you look at the goings-ons at the Federal Reserve and Chair Powell and his statements, he's been very adamant that the target is not going to change. And that would be, I mean, if you change the target, you can imagine the consequences, especially within the financial markets, where you would see a pretty dramatic repricing of just about every asset that there is. So I don't think that's a high likelihood of happening. Maybe over the long run, that's something the Federal Reserve as sort of an institution kind of reconsiders, and maybe they calibrate a new target, or maybe change the target to something else, which is a possibility as well. But for right now, that it's 2%. They're going to work towards getting inflation to 2%, and they're not going to move the goalposts. Yep.
So moving on, a different interest rate, the 10-year Treasury. I've always kind of heard it was, maybe inflation plus GDP is sort of the target that you'd have for that. I'm curious what your thoughts are on U.S. Treasury prices today and going forward. For stabilized financing, that's really the most highly correlated index on interest rates. So I'd love to get your thoughts on that.
Yeah, I think one of the things with you go further out the yield curve, and I think yes, like you're going to see more reductions in the federal funds rate, and maybe that has like a similar impact on 2-year Treasury, right? As you move further out, the Fed has a lot of influence, but then you start to have to consider long-run inflation expectations, expectations for growth over the long run as well, but then also fiscal policy. So that's been the other big change that we've seen this year, really over the past few years, is you've seen the deficit really widen out to very large levels, right? And so the example I kind of give is right now, if you look at the deficit as a share of GDP, it's right around 6%. which is elevated relative to history, especially when you consider the economy is still expanding. You have a 4 on the unemployment rate, and the Fed's cutting rates. And so what you see here is a steeper yield curve, I think, moving forward. The 10-year Treasury, our forecast right now is for 10-year to kind of hover between 4 and 4.25 over the next few years, mostly due to the fact that inflation, it's probably going to improve, like we talked about, but you're still kind of a little bit, north of 2%. And then you have the fiscal issue, which I think exerts pressure on the longer end of the curve. So you've seen that. It's, I think, a reasonable base case to have. Kind of going back, we were talking about historical averages. 4 is, right around the historical average for the 10-year Treasury. But the change, I think, is what the challenging aspect of this is for real estate, right? Because it's impacting residential mortgage rates, commercial mortgage rates, and I think it's still a limitation across the board. So I think that's, the reality. Long-term rates, maybe they come down a little bit, but this year we've been a little north of 4%, and I think that makes sense kind of moving forward.
Yeah, going back to the deficit as a percentage of GDP, one of our very bright analysts and I were discussing, as we were writing the quarterly letter, how Ray Dalio, in his book, he studied several countries and great societies, civilizations, and and the book is on credit bubbles, but what he said is really a country needs to target no more than 3%. When you get out of 3%, you sort of get in this fiscally unhealthy and maybe even unsustainable place. And as you mentioned, we're I think just over 6%. I think in 2024 we were closer to 7, maybe 6.8%, and there's been a lot of growth, which has helped on that. But getting back to the tariff question. As we were looking at the revenue that's generated from tariffs, at least projected, and we don't know how much is actually fully going to be collected and if it'll be moderated going forward, but it does reduce the gap that we'd be in terms of being able to increase federal revenues or taxes to be able to shrink that deficit slightly. I think the math was roughly like a third or so of that gap was starting to get covered by the tariff revenue. Are we seeing, as a result of tariff revenue, any sort of improvement? Could that maybe be, if we have these in place and we have to live with them, we can't change them. There's two sides to every story. But is that maybe something that is helpful for fiscal sustainability? I mean, maybe it impacts GDP. Complicated question, but what are your thoughts if you're underwriting the 10-year Treasury and the U.S. fiscal sustainability? Does that help? Is that not?
So yeah, a number of things here. Yeah, all else equal, probably helps a little bit, right? It's hard to say exactly, but it helps a little bit because you've seen this year, you've seen a very significant increase in tariff-related revenues to the federal government. So that'll be helpful. Now, the big question is, the Supreme Court is they heard the arguments on the roughly 50% of the tariffs that were under question, and so there's some uncertainty with how permanent those revenues are going to be.
Yes,
sort of on a moving forward. And so it's really hard to say. And then you kind of think about the impacts of tariffs and how much you can kind of sustain that source of revenue over the long run, right? Because there's consequences for the economy, which if tariffs lead the economy to slow down, that could have some potential impacts in terms of overall revenues and sort of complicate the.
Yeah, I mean,
the net.
I would assume that anytime you increase taxes, that probably has a negative impact on the economy.
Mm-hmm. And it's a very uncertain question. I think there is some scope for it to help a little bit, maybe around the edges, but I would not sort of assume that that's going to be sort of a silver bullet that helps.
Yeah, not silver bullet, but just something because we'd like to think that interest rates are going to go down. But if the 10-year Treasury, if people are really underwriting the credit of the United States, that's not improving. And so, some people that maybe are holding out to refinance their home because they're expecting interest rates to go down.
Right.
And I think that's largely been a consensus that economists have shared over the past 12 months that interest rates will be going down. And I mean long-term, not short-term. But I'm challenging, and I'd love to get, kind of what you're saying is, if the 10-year Treasury is largely a reflection of, liquidity in the market and the demand for the U.S. Dollar or T-bills, and a lot of it's based on the creditworthiness of the issuer. Is 10-year rates should they go down?
I think another sort of important thing to consider is I think markets are priced. So the fiscal side of this is certainly having an impact, but it also almost always comes back to the Federal Reserve, right? And where setting interest rates and what financial markets are sort of expecting for you can think of it as like the terminal Fed funds rate is going to be. So I mean, if you're thinking about where the balance of risks are in terms of like the 10-year Treasury yield, I think maybe skewed to the downside a little bit, not like materially slow. If you think, okay, where are the risks for the Fed funds target rate? So right now our forecast is for the Fed to bring the Fed funds target rate to between 3 and 3.25. Right, and I think for that, I think you have to assume the risks are skewed to the downside, just based on what you see in terms of mounting downside risks in the labor market. In plain English, that rates could come down more than where markets are kind of expecting. So if that happens and markets kind of price for a lower Fed funds rate, I think that could help, sort of materialize a lower 10-year Treasury as well. Maybe not, as much as many in real estate would hope for.
Yeah.
But I think that sort of downside risk to where rates are, both in terms of Fed funds and sort of at the longer end of the curve, is still there.
So you study real estate, not just the federal funds rate or interest rates. Obviously, interest rates went up, and you saw real estate values go down. And in the public markets, they went down very fast. In the private markets, maybe not as fast because people don't have to transact. But cap rates started to increase, and it seems and feels as though cap rates are stabilizing, and I'd like to get your thoughts on maybe historically the relationship between a cap rate and the U.S. Treasury or interest rates in general, and how you see the current interest rate expectations maybe influencing real estate values, transaction activity.
Yeah, it's been a very challenging past few years. I think it's safe to say for the commercial real estate market as a whole. Right, and you mentioned, real estate is one of the most interest rate sensitive sectors of the economy there is, and I agree with that. The positive, I think, really since the Fed started cutting the Fed funds rate back in September of 24, is that you have seen more stability in valuations. This year you're seeing cap rates, steady, right, not rise as fast as they have been. In some instances, coming down a little bit, depending on the property type.
And what property types are you seeing them come down on?
Yeah, so I mean, you've seen, depending on whether you're looking at like a quarterly or like 12-month moving average, you've seen multifamily come in a little bit. Nothing like material, but at a minimum, not rising as quickly as it once was. So you kind of have to wait and see how that plays out over time. But like the recent data are kind of pointing towards stabilization, I would say, across the board. And interest rates are certainly playing a role there, right, and pushing things up. But it's not just interest rates and like the 10-year Treasury certainly have a big influence on cap rates, but what you see is it's not a perfect one-to-one correlation, and there are other influencing factors, right? And so one argument I've been making is that capital flowing is just as important to kind of to cap rate compression as interest rates are, right? And so that's another positive thing that we've seen really for the past year is that capital is coming back off the sidelines across a wide array of different CRE capital providers. So after the pandemic, Fed tightens policy because we have very high inflation. As a result, what you see is a pretty significant tightening in terms of lending, and that net has eased over the past year. And what you're seeing is banks, that's the big one, but CMBS, life insurance companies, the agencies, still like a lower level, but you're starting to see growth, which to me points to the capital is flowing once again, and I think helping that the cap rates kind of steady out.
Yeah, I'm looking at a chart you provided, and it's CRE transaction volume by property type, year-to-date % change, and just reinforcing what you were talking about, capital coming back into the space. You see transaction activity increasing across all the major sectors with the exception of hotel. Right? We can go back to that, and I'd love to get your thoughts as to why. But retail is at year-over-year increase at the highest at 17.7%. You have office at 15.7%, which is great. Then third is industrial at 10%, and then surprisingly, multifamily is just under 5% at a 4.9% change in transaction activity from last year. What is going on with the capital that's flowing back into these markets? And then hotel is down, almost 10%, 9.6. What are these numbers telling you, and what are the stories behind these that you?
Yeah, I think one, you have to kind of caveat this. These are the year-to-date growth rate numbers for this year, and they're positive So that tells me that maybe an inflection point has been reached, but they're coming off of very low levels.
Sure.
So let's start there. But I think, if you kind of go through the different property types, I think each has its own sort of individual story. So yes, rates are a little bit lower. Capital's moving off the sidelines. There's more enthusiasm, more sort of optimism around commercial real estate. I think that's sort of the rising tide that's sort of starting to lift all the boats currently. And then every individual property type here, I think, has the idiosyncratic reasons. Maybe if you look at office, I think office valuations, broadly speaking, probably fell a little bit more than all of these other asset types, especially central business district office properties. And I think that's sort of represented an attractive opportunity for some to kind of move into that space. Apartments, what you see in the multifamily world is that similar to office, valuations have kind of come down. But the value proposition for a lot of multifamily is, I think, structural in nature, meaning you have the single family market that is structurally undersupplied. There's affordability constraints because of where mortgage rates are, and neither of those are being resolved in the short run. I think that's safe to say. And so what you're seeing is rental demand sort of still being quite strong. Sort of defying expectations. So on the supply side, you're kind of starting to move past this peak, very strong supply wave, but that's sort of tapering off. And so supply and demand in multifamily is starting to come back into balance. So I think that's sort of maybe explaining the apartment side. Retail is a sort of sector that's, if you look at just vacancy rates have maybe inched up, right, outside of the hard-hit mall sector, but retail rates, if you kind of look at the chart of just the major property types and their vacancy rates, you see increased, after increase. The retail has kind of remained, steady, not really rising all too much. So I think, long story short, I think all of these different property types have their, supply and demand, and why sort of investors are sort of choosing them. Industrial, I think, is another, area that it's been a very fast-growing segment for a variety of reasons over the past, decade, really. And I still think that momentum is still there. Hotel, you asked about hotels, sort of one of the more cyclically sensitive, I'll say, segments, right? And you kind of see it in occupancy and daily rates and RevPAR, where this year you've seen some softening. And so I think that maybe.
And is that just kind of a return to normal after COVID highs, or post-COVID travel bug craze, or is that like an early indication as to a softening of the economy?
I think it's consistent with this moderation in the consumer that we've seen. So the consumer's still holding on, but they're becoming, they're more discerning. So what you see is like discretionary spending, flat essentially over the year, right? And so that tells us that they're a little bit more cautious. They're looking for ways to kind of, reduce costs, and so maybe they're focused on ways to kind of rein things in. But if you look at the discretionary side of spending on the consumer, which you've seen, that's weakened a little bit more than the overall aggregate numbers. And so I think that's very consistent with a softening that you've seen sort of in the hotel market.
I'm curious. I could probably look this up, but the softening, has it been more impacted in weekend travel versus weekday travel? Is it the consumer that's pulling back, or businesses?
Yeah, so it's to me, it's two things. So what you see if you kind of break down the hotel market, and we talked about sort of the K-shaped economy, I think you're seeing that trend very evident in hotels. So if you look at the luxury end, right, luxury hotels are performing a little bit better than some of the more downscale properties.
Yep.
Right, and then I think that's telling you that at the higher end of the income spectrum, that's holding up for higher income households. But it's also telling you, I think, that corporate travel right now is sort of a little bit more resilient than the leisure element, which is very likely kind of downshifted as households in general have become more cost focused, but especially at the median income and below, where consumers appear to be a little bit more constrained.
Yep. And so looking at, you talked about multifamily, interest rates are high, so it's affecting affordability. It's tougher to own a home. It's more expensive to build a home. There hasn't been a whole lot of construction on the residential side. There's a lot of talk about how we make housing more affordable. And I feel as though, anytime, lowering interest rates, it actually makes things more expensive. You kind of need to destroy value to make housing more affordable. Do you have any thoughts or perspectives on what it would take to make housing more affordable. I mean, I'll just say, like, if you just say supply, oversupply, I imagine what this means, and I don't know if everyone understands this, but we need to see the U.S. lose a lot of equity in U.S. homes, right? In order to make it more affordable, like make home values have to go down.
Yeah, and that the ripple effects there would,
Oh.
I would argue that wouldn't improve affordability because you would see, a loss of equity, and that could have some really
majority
negative
of
economic
the wealth
consequences.
on
Yeah.
Main Street is in
And so that would affect the income side, right? And so to me, the most plausible way you see improved affordability conditions is, and none of this is sort of a base case, but maybe mortgage rates fall down more than we expect. Okay, so maybe that helps a little bit
for like 6 months until that gets factored into pricing, right?
Yes. And then that's just, so it's very complex. And I'm not saying any of this is going to happen, but my point is it's got to be a combination of things that happen in concert over time.
Yeah.
Right. So maybe mortgage rates, let's just say they stay steady. Maybe home prices continue to rise, but at a manageable rate, 2-3%, not the 6, 8, 9%.
Yeah, historical.
Right.
Yeah, recently.
So you get home prices that are steady, mortgage rates predictable, and then incomes that continue to grow, and that's dependent on the economic cycle kind of continuing. So it's not going to be next year, very likely not in 2027 either, but over time that'll help. So it's a really challenging situation, right? I think you're making this point about rates and how it impacts the supply side, right? I think the other thing you can do is kind of build more homes, right? So I'd argue we're undersupplied by about 4 million housing units right now, and that's sort of a conservative estimate, right? There's a wide array of different studies that it's 4, it's 7. I've seen as high as 20 million. So I think that there's an undersupply of homes that are geographically mismatched, right? And so we're sitting here talking in New York. Housing construction has been especially slow here. In the Sunbelt areas, right, there's been significantly more. And so I think there's that geographic mismatch. But overall, I mean, it's clear that we don't have enough housing. We don't have enough affordable housing. And so I think one way to help that is to kind of build more, and especially build more homes that the entry level can kind of afford and gain access to.
But yeah, I mean, building more, it's the old real estate supply and demand thing. Is more supply, is going to spread that demand. Hopefully prices are going to come down. But I think you still get in the same place where you have to see prices go down. I mean, you're building more with the hope of lowering home values. So I think from our perspective, multifamily is really interesting right now because, home builders, construction costs are so high. Tariffs are making a lot of that construction costs continue to be high. We don't see those costs going down. That affects both the multifamily and the single family side. But on the multifamily side, there just hasn't been a whole lot of supply added, and you don't have the same number of people that are able to graduate out of multifamily into single family, through household formation as maybe you used to. And maybe that changes. Maybe incomes go up, and for a short period of time, interest rates go down, and they're able to not be fully passed through to home prices and allow people to buy a home. But from our perspective, we do think multifamily is a very compelling place to be, particularly in more of the workforce housing, where it truly is impossible to build that and still offer those prices without some sort of federal subsidy. So, but yeah, it's an expensive time to be alive. So, and I wish I saw that changing, but I don't. Okay, you talked a little bit about the consumer. Sorry to bounce around, but the consumer has kept retail, strong, going for the most part. I think you mentioned that, it's slowing down, but it's still like a relatively stable asset class that's done, fortunately, very well as of recent relative to the performance over the past couple decades. When do these high interest rates start really impacting the consumer in such a way that they change their spending habits and you start seeing retail get hit? And are we already seeing some of that, like in the credit card default data or anything else that's concerning to you?
I mean, there's definitely some signs of strain out there, whether that be, higher, what I would say is more normal, but higher delinquency rates, especially if you look at, the subprime auto sector, or maybe for student loans. Consumers in general are leaning more on credit cards to go out and spend. So those are those signs of strain, I would say. And I think it's, near term, next few quarters, maybe that moderation kind of continues. But I think it's also worth mentioning sort of a longer run sort of forecast here where you have this near-term moderation, and some of that's the result of higher consumer interest rates, right? Which is part of monetary policy, I would say. So if you think, okay, if the Fed kind of continues to cut, that helps consumer rates come down a little bit. That'll help alleviate some of the strains, I think, that you see in the consumer side. On top of that, you have maybe some of the positive impacts of fiscal policy coming, right? So we didn't really talk a whole lot about the One Big Beautiful Bill Act, right, which is signed into law.
Yep.
And so I think you kind of go through the different provisions there. I think net, I think it's a positive for the household sector, right? Especially for median income and below, because if you look at the impact of child tax credits going up, if you look, no taxes on tips and overtime for seniors and auto interest, right? But I think that lower or the median income and below probably benefit more from that, and that's going to come in 2026, right? So February, March. When households start filing their taxes and maybe experiencing a higher rebate, I think that's going to help some of the strains that you've seen in the consumer sector. So I think later on,
you think it's material. Those are the.
I think it's going to help prevent a continuation of the moderation that we've seen.
Mm-hmm.
I'm not saying the consumer is going to crush it next year. That's not what I'm
saying.
saying.
Yeah,
I'm saying,
but
it's going to be a support.
Yeah,
and I think that's important because it's such a big piece of
it will show up in the data.
It'll show up in the data.
Yeah.
So it's one of the reasons we actually think the economy will probably be a little bit stronger next year is because of this sort of expansionary fiscal policy that we have kind of coming down the road.
Mm-hmm.
So I think layer on top of that the effects, indirect, direct of easier monetary policy, whether it be on lower rates for consumers or the positive impacts on the labor market and stronger job growth. I think that'll be, again, support factors for overall consumer spend.
And what about Fannie and Freddie? There's a lot of talk of privatization. I think they actually now are formally moving that direction. What are the chances of them being successful and being able to raise the liquidity to do this? And then what sort of impact do you think it would have as the largest lender in maybe the world, certainly in the U.S., on home prices and multifamily values and interest rates?
It's hard to say because they are such a major part of the residential market. And people smarter than myself who follow this very closely will tell you that the likelihood of privatization near term is still probably pretty low because of the capital position of Fannie and Freddie. That being said, it certainly seems like it's a focus area of the Trump administration, as it was during President Trump's first term. So, I think, a reasonable base case might be maybe they kind of move the football down the field a little bit, but you have these constraints from a regulatory standpoint because of, the capital position. And the fact that there's maybe not a lot of political appetite to kind of disrupt the housing market at a moment in time where housing is kind of in a precarious place, right, because of the impact of high interest rates and affordability. So it's tough to kind of put odds on it, but I think it's definitely going to be a focus area. And I think the Trump administration are going to try to come up with creative ways to kind of, at a minimum, kind of move the ball further down the field.
Okay, I'd love to keep going on this. So many of these topics we just touched on, and I could, if I had a glass of whiskey and a cigar, sit here for hours picking your brain on this. But it's been a pleasure, Charles, having you on Boots on the Ground podcast. Thank you so much for your time. I appreciate it.
Hey, thanks for having me. This was great.
This podcast is provided for information purposes only and is not a podcast of Wells Fargo's Equity Research Department. It does not constitute equity research, an offer or solicitation to buy, sell any security, or individualized investment, legal, tax, or other financial advice.
Boots on the ground, we don't back down. Every step's a fight.